Minnesota has a budget surplus of over $9 billion, and the Senate Republican majority has advanced a tax bill that would use much of the surplus to provide tax relief. The bill passed the Senate in early April on a vote of 42 to 24. Tax Committee Chair Carla Nelson joins me to talk about key aspects of the proposal. Welcome.
Good morning. Good to see you.
There are two big components of the bill, the first of which is reducing the first-tier income tax rate from 5.35% to 2.8%. What will be the impact of cutting this first-tier rate nearly in half, and why this approach?
Cutting the first-tier income tax rate will bring tax relief to every Minnesotan that pays income taxes. And specifically, it will target that relief. The greatest percentage tax cut goes to those who make the least amount. The very smallest, a 1% effective tax cut, would go to those who are at our highest income tax levels. So it's a progressive tax cut, just like our tax system is very progressive. Those who earn the most pay at the highest rate. So it will cut everyone's income taxes, which is really important at a time of skyrocketing inflation. And also it's important to know that Minnesota is a high tax state. No matter how you look at it, we're a bit of a high tax island. And this gets us a little bit closer, a little bit not so far out of the mainstream in our taxation.
The second major component is the complete elimination of taxes on all Social Security benefits. As of now, people above a certain income threshold do pay taxes on those benefits. This change would remove all of those taxes on Social Security benefits. Why should those benefits be completely exempt from taxation?
Well, those benefits were purchased already when Minnesota workers' paychecks were taxed month after month, year after year, decade after decade. Minnesotans bought those benefits. And for then Minnesota to turn around and say, and now we're going to tax you on those benefits that you already purchased, is just wrong. We should be joining the over 30 other states that do not tax Social Security benefits. And that also includes, we will not, under our proposal, we will not be taxing those Social Security disability income payments either. So it is time that we join the majority of other states and not tax those benefits. It's double taxation.
You referenced inflation just a moment ago. Inflation, I think most Minnesotans are starting to feel the sting of it right now, but inflation is also going to impact the cost of state government. So with these permanent income tax cuts and the removal of taxes on Social Security, will the state have enough revenue in future years to meet its obligations?
Well, I think that is a very good question. And the thing to know is we have over a $10 billion surplus. We have a structural balance. We also have $2.5 billion in our reserve account. So the reserve account is there if there is a shortfall, and that is full, that is topped off. So we have taken that rainy day fund and we have topped that off. Now these are additional tax collections that have come in over and above our budget. And I would note too that we are not in a budget year. We're just not even halfway through our budget, and yet we have a $10 billion surplus. So at a time of massive inflation, it is the time to specifically return this to Minnesotans. I think they know best how to spend that or how to have those dollars to help with their bills, not necessarily send it to the Minnesota state government, where, as you know, our budget has been increasing greatly over the years. We're at about $54 billion now. We're increasing at about $2 billion clip a year. So it is definitely time to return this money to the Minnesota taxpayers who have overpaid. It'd be kind of like if you got home and looked at your receipt, you'd been at your favorite store, and you saw, well, you were overcharged. And you went back to the store and you said, you know what, I was overcharged for these items. I paid more than what they cost. And the store said, yes, we know that, but you're not getting the money back because we know how to spend it better and we've given it to someone else. So I think it's time to return the money to the taxpayers.
Now, the Senate plan is just one plan. The governor has proposed rebate checks or refunds, one-time refunds of $500 for individuals, $1,000 for couples. The DFL-led House is proposing targeted tax cuts and credits that their House tax chair says will be focused on helping those who need it most. So within these three ideas, is there a compromise to be found?
Well, I think so. I think there's always work towards doing what is right. I would say in this case, certainly Minnesotans can do the math and they understand the difference between a one-time relief and permanent ongoing tax relief month after month, year after year. And also, I think you also have to look at the whole context, which is we are this very high tax state. So I think there is room, but the Minnesota Senate is really focused on supporting Minnesotans, giving them the refund that they paid in, knowing that they know best how to spend that. So, and the other thing is, it's not a budget year. So all of the spending, and the reason the governor is doing, $8 billion of new spending and then these one-time checks, this is not the time to increase spending by $8 billion. Now, next budget cycle, we might look at that, but this is not the time to do that.
The Senate, let's go here. You are currently the tax chair, but before you were the tax chair, you were the education chair. Mm-hmm. And one of the criticisms of this Senate tax plan is that the bulk of the surplus is going to tax cuts and not nearly enough is going to education. Considering the size of the surplus and the challenges that are facing schools, should more money be directed towards education?
Well, I think that is a very good question, and it's a timely question. And let's just go back to the fact that this is not a budget year. So when we come in next session and we have a budget year, that will be the time where we'll be looking at education funding and the entire state budget. But let's talk about education funding momentarily. Certainly, we have had record increases in funding, both under the current Chair Chamberlain, and under my chairmanship as well. We had record funding increases in education. And I do want to note too that we had over $2 billion of funding for education come into Minnesota just for COVID relief. But the real challenge is we have had a declining birth rate for over a decade. And we pay based upon the number of students. The money follows the student. And we have fewer students, and we have continually had fewer students. That is the real issue. And then, of course, with COVID, many parents realize that, well, maybe there's other options for education, or maybe we can use some online options. So parents are also choosing where they think their child can get the best education, and they're making those choices. But the big picture is a declining birth rate. We have fewer students.
This bill is the big picture, but it is not the complete picture. You told reporters recently that the tax committee will now be working on an additional tax bill that will deal with property tax and some other issues. So what more is coming?
Sure. Those things that were not in the first tax bill, those things would be property taxes, local option sales taxes, TIF, aids and credits, those type of things. So those are coming, and we are working on those right now.
And ideas for when the complete tax bill will be all finished and ready to be looked at?
Well, we hope it's soon. We do know this, the last day of session is May 23rd, and so we need to get our second bill off the floor and into conference committee. But as you know, tax bills have to originate in the House, and they haven't passed any tax bills yet. So they will get their tax bill on the floor, they will pass it, we'll get our tax bill, our second tax bill on the floor, we'll pass it, we'll come to conference committee, and we'll see where we can marry those up.
Senator Carla Nelson, always a pleasure. Thank you.
Thank you.